Hey traders, Gavin McMaster here with Options Trading IQ, and today we're looking at selling put options with a small account of 10,000 or less. Just a quick reminder, everything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. So today we're diving into how you can sell put options with a small account, even if you have $10,000 or less. Selling put options is a great way to collect option premium and maybe even buy stocks you love at a price you're comfortable with, all while managing risk. So what is put selling? When you sell a put option, you're essentially agreeing to buy a stock at a specific price, called the strike price, if the option gets exercised. In exchange for this obligation, you receive a premium upfront. This is your immediate income from the trade. Here we're looking at a standard payoff graph for a cash secured put. If we sell a put at 110 is the strike price, we receive $800 for selling that put. That's our maximum profit. And our break-even price is 102, and below that, we're going to start losing money. So why would we sell puts? The main reason is the income. When you sell a put, you collect a premium right away. If the stock stays above the strike price, the option expires worthless, and you keep that premium as profit without ever buying the stock. If the stock price drops below the strike price, you might be assigned, which means you'll have to buy the stock at that price. That's why it's important to only sell puts on stocks you wouldn't mind owning. Essentially, you're getting paid to potentially buy a stock at a discount. With a small account, you're limited in the universe of stocks you can sell puts on. For example, buying 100 shares of Microsoft would cost around $42,000. So you obviously can't do that with a $10,000 account. You'll have to look for stocks trading under $100 and preferably under $50. Let's look at how to find potential candidates for selling puts with a small account. So the first place I would do this would be going to barchart.com. They have a great stock screener. There might be other websites out there where you can do something similar, but basically I've got some parameters here. I'm looking for a stock between 10 and 50, total call volume above 2,000. I want to have good options liquidity and a market cap above 20 billion just to get rid of any sort of small cap names. And if we look at the results, that's giving us 49 stocks. I've sorted here by call volume to show the most liquid options. And we've got Palantir, Bank of America, Robinhood, Intel, Carnival. So some really good options here. Some other ones that are jumping out that can be good for a cash secured put trade is Pfizer. DraftKings is pretty good. Devon Energy. Roblox has been good in the past. And if we scroll down, US Bank Corp. On is an okay stock as well, just there with the 50 strike price. And that's probably all that's jumping out at me, but there you can have a look through that list of names or run your own screener based on those parameters. The other thing you can do, Barchart has a really nice ETF screener as well. So just run a similar scanner for anything between 10 and 50 with good call option volume. So we've got the Chinese ETF, a lot of activity in that at the moment. The silver ETF, financials, Bitcoin, ARK, emerging markets is a really good one. The gold miners, Brazil, iShares is another good one. Schwab US dividend equity ETF is a good one as well, potentially. The solar ETF, I saw that a second ago. There it is, TAN. It's a good one, the real estate ETF. And then at the bottom, we've got some of these yield max ones, which you can potentially do the strategy on those, but just be careful with those. They're a little bit riskier. So that's a good way to find some of these. Let's just do a quick comparison or an analysis on some of these. For the ETF, I'm going to use EEM. Really good liquid ETF. And we see that stock's trading about $46. And if we were to sell a put, in terms of days to expiration, about 30 days out, 30 to 45 days is a pretty good sweet spot generally for selling puts. So we could go for the first strike out of the money, or we could go based on delta, like a 36 delta or a 25 delta is pretty good. Not a huge amount of premium there. So with a small account, you're probably going to have to go a bit closer to the money to try to generate a little bit more premium. That does increase the chances that you're going to have to take assignment. So keep that in mind. So let's run some numbers on this one. I've got a cash secured put calculator, which I'll drop a link below where you can download this and Just going to bring this over and drop these numbers in. So I just need to put that here. There we go. So expiration date is November the 15th. We just need to fill in the cells in green here. Stock price is 46.36. Strike price was 46, and our premium, if we take the midpoint there, is about $1. So our break-even price is 45. We've got a roughly 3% decrease to our break-even price, and if the put expires worthless, that's our return, which on an annualized basis is about 25% per annum. Sometimes what I'll do with my cash secured puts is I'll go a little bit longer term, which generates a bit more premium, but it does result in a lower annualized return because our theta is a lot lower. So I'll sometimes do 6-month cash secured puts. You can also see that the bid-ask spread is a little bit wider when you go longer term, which can make it a little bit harder to get filled at a good price. But if we look at this example, see if I can get these both on here. And our premium in this case is 246, so results in a higher return. I've got to change my date here. A higher return, higher absolute return, but on an annualized basis, it's quite a little bit lower at only 13%. We do also have a slightly bigger decrease to our break-even price. So a little bit of a trade-off. It's all about finding something that works for you. Most people are going to go with this sort of 30 to 45 days to expiration is usually a pretty good sweet spot. And what some people will do is go with a much higher volatility underlying. So if we go back to our list here, I'm just going to put, I didn't have implied volatility, so I'm just going to add that in. And let's have a look at, say, Robinhood, which has a really high implied volatility. So 72%, if we compare that to EEM, the implied volatility is only about 22%. So we're going to see fairly different numbers here. So we're going to be much higher returns available, but obviously Finance 101 tells us the higher the return, the higher the potential risk. So doesn't necessarily make it a better trade, but some people will do this with a small account. They might go with higher risk underlyings. Obviously, you've got a much bigger risk that the stock could have a big decline, resulting in some unrealized losses. So do be careful if you are choosing high volatility stocks. They will move around a lot more than an ETF or a low volatility blue chip type stock. So each to their own. Just be aware of the risks. So the price there, stock price is at 26.35. Strike price is 26 again, first strike out of the money. And here we're generating $2 in premium on a much lower priced stock. 10% margin for error and a 95% potential annualized return. So that's pretty attractive if you've got a small account, but again, high return equals high risks. You've got a big potential that a stock like this could drop 30, 40% in a very short space of time. The other thing you can do if you want to cut down the risk and reduce your margin requirements is turn it into a bull put spread by buying a protective piece. We can go out of the money and just pick up, say, a really cheap put option. And maybe we buy this for 20 cents. At least that way we know if Robinhood stock goes to zero, the most we're going to lose is the difference between the strike prices, $7, less any premium received. And if we pop that in here, we would receive 207 and we'd have to pay 21 cents for buying the protection. Doesn't really impact our annualized return very much, but we've protected our downside. So that's something you might consider doing if you've got a small account, just to have that little crash protection, help you sleep a little better at night. And you know that if the market really crashes, these stocks have a big 50, 60% drop, you know you're covered below a price of 19. That's going to be a maximum loss. So keep that in mind. One of the main risks of selling puts is assignment. So if the stock drops below your strike price before expiration, you may be assigned and required to buy 100 shares at the strike price. For example, if you sold a put at 30 and the stock falls to 25, you'd still have to buy it at 30. And if you think about our Robinhood example there, If the stock drops below 26, let's say it drops down to 20, we still have to buy it at 26. So we're going to be sitting on a loss of $600 less any option premium we've received. So that's the main risk, is that you are going to have to buy the stock if it drops. So for that reason, only do this strategy on stocks that you're willing to hold for the long term. While assignment isn't always bad, especially if you want to own the stock, it can tie up a large portion of your capital. For small accounts, this means that after assignment, you might not have much cash left to make other trades, and it can also result in a lack of diversification if a lot of your capital is tied up in just one or two stocks. One way to potentially avoid assignment is to roll your cash secured puts if they go in the money. Check out the video in the description below on how and when to do this. One of the most important principles in risk management is avoiding over leveraging. So with a small account, it's crucial to only sell one put contract at a time and make sure you don't have a bigger exposure than your account size. So each contract controls 100 shares, so you need to have enough cash to cover the potential assignment on any puts that you're selling. So make sure you don't sell too many puts on too many different stocks if they all get assigned and you don't have enough cash to actually take assignment on those shares. In conclusion, selling put options with a small account can be difficult. Choosing the right stocks and avoiding over leveraging is important when managing risks. Consider rolling your cash secured puts to avoid assignment. Hope you enjoyed the video. Please like, comment, and subscribe. Thanks for watching and have a great day.